Hello and welcome to FT Markets. Oil prices remain below $50 a barrel, yet in recent days we've seen a lot of data suggesting that non-OPEC supply is starting to fall. Here to discuss these releases with me is Anjli Raval, the FT's oil correspondent. Anjli, welcome. So as I mentioned in my introduction, oil prices remain below $50 a barrel, yet the news over the past week's been somewhat bullish. Are we seeing indications that OPEC's strategy of keeping the taps on, keeping production going, is actually driving other higher cost suppliers out of the market?
Both the IEA, the Wealthy Nations Energy Watchdog, and OPEC have said that growth in non-OPEC production will slow, with US shale production, according to some estimates, falling off next year. And in return, what's going to happen is that there will be an increased demand for crude from OPEC, producers. So this was what was intended in November. That was the thinking behind the decision by OPEC producers to not cut production to bolster prices. So on the surface of things, it seems things are working.
Okay, so it's a bullish picture. I mean, if we turn to the next slide here, I mean, we can see then in 2016, we're seeing a tighter sort of supply-demand balance. Okay, there's still a surplus, but it's not anywhere near as big as it was this year. So, I mean, this seems to be sort of vindication of the strategy. Yeah, I do notice from the reports last week, I mean, we're citing the IEA there, they were very bullish on the slowdown, but some of the other forecasting agencies like the US Energy Department and even OPEC as well aren't as bullish. I mean, they don't share this sort of slowdown thesis, or?
OPEC itself is actually far more cautious, even though the IEA forecasts that US shale production will fall by 400,000 barrels a day. The OPEC is saying actually there will still be growth, albeit smaller, at 50,000 barrels. There is a big range in terms of what people are expecting, and it's going to take a lot longer for things to shake out before we really understand what this means for the overall supply-demand picture.
Okay, and that's because the US shale guys are becoming more productive, more innovative, learning to cope with lower prices. So, I mean, that, if we bring up the next slide, just looking at the various forecasts for sort of non-OPEC supply growth next year, there could be a wide swing on that sort of range there.
Right, and it's not just the US, but also other non-OPEC producers too. But the crucial point to remember is that October is the month when a lot of banks will reassess the values of a lot of oil and gas producers, particularly in the US, and then we'll get a better idea of how these guys stand in terms of their financing and what this then means for production. So we have to sort of watch out now for going into the next month or so.
So that's going to be potentially a crunch point for the shale industry then, something to closely watch out for. But also, I mean, we shouldn't just talk about the shale guys. Also, we've got the big oil companies cutting production, well, not cutting production, but certainly cutting costs and putting through big sort of programs to reduce their outputs. I mean, we're not likely to see that show up in the balances next year. Is that a longer term sort of prospect?
I think most oil analysts are saying that there is going to be there is likely to be a big swing upwards in terms of price, but when this happens, nobody quite knows. Even the IEA and OPEC are still talking about production cuts really showing up, well into next year. So we've still got a long way to go, a long time for oil prices to, carry on hovering at around, let's say, $50. And if this does continue, a lot of the big oil producers, even Saudi Arabia, which is among the wealthiest, they are really going to take a knock to their finances. So we can't forget that either.
But not to get too technical, and if we were to look at the futures curve on the oil market, it does seem to be suggesting that next year is going to be much better in a price perspective than this year. I think the spread is sort of $8 between now and then. So, I mean, the market is getting slightly more bullish. Of course, it can be wrong, but it does seem as if there are some inklings that people are getting more positive on the outlook for the oil market.
And this month alone, we've seen hedge funds sort of betting the other way and saying, looking further out and actually factoring in production cuts along the way. So I think there is a sentiment change, which over much of the summer didn't exist.
Anjli, thanks very much. So a more positive picture then potentially emerging in the oil market, yet there remains much uncertainty and a lot to follow over the next 6 months.